Hey, everybody, welcome to today's episode of The Sense of Things. Today's episode, we're going to cover the current earnings that are happening out there. We're in the midst of earnings season. We'll talk about the ones that have happened and the ones that are upcoming and our feel on how that's going to affect things going forward, what some of these current earnings reports are telling us, especially inside the sector. So we're going to get into a little bit of a sector analysis today. We'll also talk about corporate tightening of banking tightening that's going on out there, which is going to have some effect, I think, on small to mid-sized businesses, especially. And we'll finish it up today with just a quick little discussion about what some of the things that we see affecting the markets going forward. So stick around for this episode of The Sense of Things. Hey everybody, welcome to The Sense of Things. I'm Jeff Kikel, and my co-host is Ron Lang of Atlas Wealth. Ron, welcome, man. How you doing?
Good, Jeff. It's a good Wednesday. How about you?
It's a great Wednesday. You're getting ready to head on an airplane here pretty quick, right?
I am. I'm ready to head back to our Philadelphia office, and it's all right. Good balmy weather back there, but it's springtime, so it's good.
Yes. Springtime,
Just
it
getting
could be
hot here. It'll be
snowing.
90s in Phoenix this
Ugh.
weekend, so I'll take the 70-degree weather in Philly.
Exactly. Yeah, you can go back ever so often and do that. So, all right. Well, folks, today we're going to talk a little bit about the corporate earnings reports. We're in the midst of earnings season. A lot of companies are reporting this week, and a lot of them have already reported. And it's been an interesting swath of different companies. Some of the big companies that have reported or are reporting. JP Morgan, Netflix, Delta, United, Schwab, United Healthcare, those are companies that are bellwethers in certain industries. Ron, what's your initial thoughts about the earnings season so far?
Well, a lot of the earnings beats that they're beating earning guidance that was guided down over the last 30 to 60 days. I think FactSet came up with a number that they're expecting another quarter down for earnings about 6.7%, 7%, whatever, however you want to look at it. So
Hmm.
the fact that some of them are beating doesn't surprise me. Their
Yeah.
guidance was tepid at best. I don't know how you feel. The big banks to me are going to be fine. It's
Yeah.
going to be the mid-size, the regional banks. They're holding the paper for a lot of the commercial property debt that's coming due in the next couple of years. So it should be interesting to see the way they handle it. But my big thing with earnings right now, Jeff, is going to be the tech companies over the next two
Hmm.
weeks. We get the banks last week and this week. It's going to be the tech companies over the next couple of weeks because typically tech is ahead of the curve. You know,
Yeah.
they cut deeper and earlier than most companies with retrenchment of employees. But typically, if they're going to give a tepid or a gloomy forecast, they're going to be the ones that are going to do it before many of the other businesses and industries. I don't know how you feel.
Yeah, I mean, I got that. I think some of the highlights I saw out of this week, JP Morgan, super bellwether bank. We also saw this morning, Morgan Stanley, both of them really good earnings reports. The what I saw out of Morgan Stanley, I mean, they saw a drop in their assets under management, but it was kind of minuscule. I think it went from 1.4 trillion to 1.36 trillion, which,
Right.
with markets down over the last year, that describes it right there. But showing not a major move out of the I think the money management side of the house. I thought it was really interesting looking at Schwab. They basically beat on their earnings report, another one that was kind of guided down. But I think the interesting thing, and this is kind of inside baseball, having worked at Schwab, the bank is a major part of Schwab, and the challenge that they
Sure.
face is it's either a major detractor or a major earnings part of the company. And it's largely around the fact that the bank only really writes, they don't really write any kind of commercial loans. They really only write mortgages, and with
Right.
interest rates as high as they are, I think that's having a major effect on Schwab. Plus outflows from Schwab to the other side of Schwab, from the bank to the other side of Schwab, people investing in treasuries and things like that. They make it really easy for the investor to be able to move back and forth between the two, but that does have a major effect when they lose deposits out of the bank.
Absolutely. As a matter of fact, I heard it from two independent sources in the last week. I haven't had a chance to research it on my own, but they said that credit is tightening so badly with the banks, meaning they're not giving out money, which
Yeah.
is, the I mean, that's their DNA. That's what they've got to do. And I
Yeah.
heard that credit standards are the tightest they've been since 2012.
Wow.
That's an ominous statistic. Now,
Yeah.
how the number, how the breadth and the depth of that, as far as major banks to mid-size to small regionals, don't know. But the fact that they're the tightest in 11 years is only telling you that everything is starting to contract.
Yeah. Well, and I think, from that credit standard part, I don't know if you have been paying attention to the new changes that are coming down the pike regarding mortgages. And it's somewhat ominous to, back in the 2005 to 2007 range, the government's coming in with different lending standards to say, okay, well, people with lower credit, which typically are people who don't make as much money, we're gonna reduce the lending standards and the interest rates for them, but for people buying second homes, people buying investment real estate and things like that, we're going to kind of throw that onto them, so to speak, and have higher borrowing costs for those folks. I think it's interesting because it kind of puts us into that weird situation that we were in back in the 2005 to 2007 range that led to the financial crisis.
Absolutely. Well, back then, I mean, obviously, mortgages brought down a lot of the banks in the market, but it was more the subprime than anything else, and not
Yeah.
knowing what people were buying. And certainly, we don't need to rehash history and give a history lesson on that to a lot of people. I don't think we see that this time. I think
Yeah.
Bank of America announced, was it yesterday or Monday, they've had the lowest default rate in 53 years.
Hmm.
Which is interesting, and that's nice, but that's also a sign of still a good, strong job market.
Yeah.
Credit card debt is still growing. Carryover debt from that credit cards is growing. I mean, we mentioned this in a prior podcast. These credit card companies are making a mint. I
Yeah.
mean, they're getting those finance rates at mob rates,
Hmm.
and and it's going to be at the end of the day when people start losing their jobs, they
Yeah.
start defaulting on that. Actually, bankruptcies have been on the rise.
Hmm.
I think it's either month over month or quarter over quarter for the last 15 months.
Yeah.
So it's starting. The cracks are there. They're starting to widen. And I don't want to be a doom and gloom in every podcast. And certainly I will be a raging bull at some point. But you got to look at what's in front of you.
Yeah.
At
Well,
least the
and I
next
think
6 to 9 months.
yeah,
But
and
I hear what you're saying. I know we got some banks that are still reporting this week. I think Goldman didn't have very good numbers the other day. Blackstone, I think, is due up soon. I mean, these are the people that really have their fingers on a lot of parts of the economy, specifically the consumer, which is 2/3 of our economy. So it should be interesting to see how earnings season pans out here over the next 3 to 5 weeks.
Well, and I think the other interesting thing, as I was doing some preparation for this, a couple companies that I saw that were underperforming, Netflix. I mean, of course, has
Yeah,
been the bellwether of the pandemic and everything else. One of the things that they announced, I think it's partly competition. I mean, you've got way more streaming services today,
of course.
and all the big cable channels also have a competing or a companion streaming channel now, and a lot of times they're only releasing certain things on the streaming channels. But Netflix was saying that they're not going to be doing more of the feature length film type projects as much as shorter term projects or short projects. So it's interesting to me. Another quarter of subscriber growth going down for them. So it's intriguing to me to watch what's going on in that communication space. A lot of competition, but really underperformance from the entire sector. So there's no real clear-cut winners. They're all kind of struggling on their way along.
Well, here's the interesting thing about Netflix and why I despise most stock analysts.
Hmm.
If Netflix was not a public company, it'd be one of the most successful private companies. They are literally minting money. They are printing cash. They have recurring revenue every single month, and nobody else can touch them. Throw out the stock price, throw out how you want to fundamentally value them. They are literally minting cash, but the stock analysts are like, they're just not growing as fast. Well, of course not. They've been around. They're now an established company, but now they've been forced, because they're a public company, you got to keep growing. Yeah. Now they're being forced to, well, we're going to have an ad option, right? I understand about they're clamping down on the passwords. That's a given. I mean, I understand, they were trying to get brand recognition but ads, well, what am I paying a subscription for? Yeah. And I understand there's different tiers, but the stock analyst, unfortunately, with a lot of companies, and when CEOs are truly being affected by their opinions, I think make bad decisions for their companies. We've seen this over and over and over and over again with tech companies, and that's why the founders and the CEOs are ousted after a period of time, because they're just not focused on next quarter growth. So that whole Netflix story frustrates me, because it's not like they're not successful and they're not growing. They're just not growing fast enough. It's insane. It's really insane at this point.
Yeah. Yeah. And I think the other piece of it is, though, as we shift into that world of, you're going from the major studios. I mean, you've seen some of these major studios have some huge flops. They spend billions of dollars, millions of dollars, and have a big flop. More and more of that is going on to these streaming channels. And yeah, I mean, I think the cost is going up of producing content, which I think that's more than subscriber growth and growth. I think that's really the challenge that most of these streaming services face is, as you start bringing on, you're not just doing the Hallmark Channel has been actors. Now you've got, the Kevin Costners of the world, the major stars that are shifting to some of these off channels like that. And it just costs a lot more money to hire them.
And it gives them the flexibility. But, the crazy thing is, it's like they're being beaten up because of their success.
Yeah.
Think about it. When you're number one and have the largest market share, there's only one place to go, down, less market share. So you take a look at Google with their search. Well, they're being challenged. All of a sudden, Google is no longer, a big growth company. Google's minting cash too.
Yeah.
You just take a look at a lot of it, like Microsoft back in the day. Nobody could compete with them. They had the largest market share. There's only one direction for them to go. They were essentially in a malaise stock price-wise for 10 years.
Yeah.
And now Netflix, unfortunately, is on that mature end of the curve. They're in the same situation.
Yeah, exactly. I thought the other note that I had, and I'd love your opinion on this, I started to really take a look inside some of the sectors a little bit, and really specifically the three worst performing sectors of the market, consumer discretionary, communication services, and financials. It was interesting to me. I mean, my take on this was, as you started to dig a little bit deeper into those, when you look at consumer discretionary, I think that's the area where, the canary in the coal mine is. Leisure and multi-line retail are the two that have gotten just clobbered in that area. And then, communication services, it's literally across the board. Every sector of that, whether it's the Netflixes of the world, whether it's telecommunications, all of those are just getting whooped on pretty hard. And there's no really good sectors in there. And then finance, it's really just consumer finance that's affecting it. It's up for the year. The money center banks are really pulling a lot of the weight there, and it's really consumer finance that's down. So those were three that kind of stuck out to me as I was looking at this.
Well, yeah, well, that's definitely getting the pulse of the consumer.
Yeah.
But, people that want to be fully invested through a possible recession, which we're expecting, healthcare usually
Yeah.
performs pretty good. And many of the big names have been holding up pretty good over the last 6 to 9 months. But I agree with you. The consumer discretionary, the retail, they're already starting to show you of slowdowns and contraction.
Yeah. Yeah. And I mean, that's, on our portfolios, I've just purposely, I have very little exposure to anything that's based on the consumer right now, or that's largely driven by the consumer, because I just feel like, we're starting to see this, and we really haven't seen, like you'd said before, we haven't really seen the big layoffs yet. We've seen the tech
No.
layoffs. We haven't really, it hasn't come down market as much. I really sense that we are going to see that in the very near future.
No, I agree. I agree. But like I said, I don't think we're going to hear of possible tranches of layoffs during earnings, other than many CEOs already, and it's limited sample size over the last week. Many of them have said there are headwinds ahead.
Yeah.
Okay. So, I mean, you know what that kind of speak is all about for them. They just want to lower the bar for expectations, if nothing else.
Yeah. Well, and especially if they have a really a turd earnings report, then, the next thing that typically happens is, oh, well, we're going to lay off a whole bunch of people, and that, that'll
Of
make
course.
things look better for the future here. So not so much for the employees, but certainly for the company, it'll look better. I thought, some cool stuff that's coming up this week, or I think some big earnings reports that I feel are important. Tesla, I think, reports today or tomorrow. IBM, I think, is, although it's not as big of a bellwether anymore,
No.
I do think it's an indication of what's coming up. Morgan, like I said, reported this morning. American Express, AT&T, and Procter and Gamble all report this week, and I think that's going to kind of give you a little bit of a feel across the board of how things are doing from those big tech, or the big bellwethers.
Well, Procter and Gamble is a good one. Rather ironically, a lot of people don't know this. Most people know Walmart represents about 10% of the retail market in the United States.
Yeah.
What most people don't know is that Procter and Gamble, about 45 to 50% of their sales is just Walmart.
It's Walmart alone.
That's why they have a second headquarters in Bentonville, Arkansas. So, how Walmart goes, Procter and Gamble goes too, however you want to look at it.
Interesting way of putting it. That's exactly right. Well, Ron, I think, the last thing I'd love to cover today is really starting to talk a little bit about the what's going on in the stock market over the last 7 days, because I think it's been intriguing to me that we're still seeing signs of, there's a signs of cracking, but the market just kind of keeps climbing the wall of worry. What's your thoughts?
I got to tell you, I've been impressed by its resilience over the last week, but I'm also a technician, and looking at the charts, it's having a tough time pushing through a certain level, like a ceiling. And I think on the S&P, which I know is sometimes a tough benchmark, but I think 4,200 is the ceiling. If it could punch through 4,200 with some real conviction and stay there for at least 3 to 4 consecutive trading days, we may go higher.
Yeah.
But I think that 4,200 level is a significant level that we may not be able to punch through. And if we do, I don't think it'll be able to have any staying power. Like I said, I think the earnings over the next week and a half to 2 weeks will be very, very telling. And if we punch through the 4,200, we'll probably go, maybe 3 to 5% higher. But if we don't, I think 5 to 10% in a relatively short time, I would say by the end of May.
Yeah. Well, and I mean, of course, if you look at what we grew up on in this industry, which was sell in May, go away, I mean, typically the summers are terrible as it is, or they're very volatile because there's less volume, less people that are playing in the markets at that time.
Well, it's funny you say that because I saw this whole little review or study about 3 or 4 years ago that the whole sell in May and go away
Yeah.
was actually BS.
Yeah.
It only like applies less than 40% of the time.
Yeah.
But you know what? It rhymes and people remember it. You know,
It's easy to
you have
remember.
this
Yeah.
sell in May go away. You have the early Fed meeting in early May,
Yeah.
and then we have the debt ceiling thing in June, and you've already started to see some rhetoric on some of the TV channels from some of the politicians starting to talk about it.
Mhm.
Those are significant headwinds, and going into a presidential election year, the GOP is definitely going to try and hang them on the debt ceiling. So we'll see
Yeah.
what happens.
Yeah. Well, and I think this is I think this is going to be a major debt ceiling fight, because there was so much discretionary spending that was wrapped into COVID. It was just an excuse on both sides of the aisle to spend ridiculous amounts of money on stupid things that help their constituents. And I think we're going to have to. I heard a statistic this morning that pretty soon our debt interest rate that we're paying is going to be higher than our what we're spending on defense in this country with the interest rates going up. I mean, it's you're gonna have to pay the piper eventually, so we're gonna have to buckle down.
If we weren't the reserve currency, we'd be a third world country of our debt to GDP. There's no doubt.
Yeah, and our ability to just keep printing money and keep going down that road, eventually it's just not going to work anymore.
Somebody's got to pay the bill. It'll probably be the next generation now.
Yep. And I don't have a next generation on my side, so unfortunately, somebody else is going to have to pay for it. So thoughts, as we kind of wrap up for today, thoughts about what you're looking for over the next week or two, out of kind of the earnings that are coming up, the markets, all that type of stuff.
Yeah, I'm interested to get your opinion on this too. I'm going to look out through mid-May because by the time we get to mid-May, I think, what is it, better than 2/3, 3/4 or so of the S&P 500 companies will have reported. I think the next 30 days, I think I have two words: buckle up.
Yeah.
I really think, because you got to remember, it's not just the earnings, right? We just talked about the Fed meeting. Don't forget, we have a big April jobs report on May 5th.
Yep.
We have a GDP coming out for Q1. There's a lot of these news things. And the interesting thing is, for the longest time, bad news was good news for the market because they knew the government was going to print money. Well, now maybe good news is good news.
Yeah.
If there's good news, maybe the market won't go down as much. Maybe the Fed will start to pivot. Everybody's going to just start cranking all this stuff through their heads. And I think it's going to be, quite frankly, paralysis by analysis. The numbers are right in front of you. And that's why I just said two words: buckle up.
Yeah. Well, yeah. And I would expect an increase in volatility as we go into the summer. It's very low right now. And I just think we're going to see an increase in volatility. It's interesting. I thought the interesting part was looking at the economic figures, so you go from, what was it, January's GDP, 6%, so, oh my God, we've got inflation. And then you go to the next month in February, and all of a sudden now the print is 5% year over year. And, the markets go, oh, it's wonderful, everything's great. And I'm looking at it going, we just saw a full percentage point drop in 1 month. That tells me that we're starting to slow down at a pretty rapid clip, but it's still not low enough for the Fed to go, hey, we're just going to stop doing anything and let it calm down. They're going to keep raising interest rates, or at least one more time. My estimate.
I agree. And there's some amazing historical stats about the time from when the Fed stops their last rate hike to a rise in the market. It's pretty amazing if they looked out 1 year and 2 years. So if May truly is the last potential rate hike, even a quarter basis point, we can expect to be higher a year from now, which I do. I just think that we're going to have a swoon in the second half, come up late in the fourth quarter, but we need a swoosh. We need a bit of a washout with the market to kind of clear out a lot of the speculators, stabilize everything, and then I think we're going to see a nice upside, towards the end of the year. But unfortunately, we have to try and step in a few potholes first.
Yeah, absolutely. And we're not fixing the potholes. We just keep making them deeper and bigger.
Well, keep printing money. I don't think we're going to be able to do it.
Well,
I think for the first time in a while, last week, the Fed balance sheet actually went down, which was a good sign. But it'll be interesting to see what happens here if we end up going into a recession, if they're going to start to now lower rates, which there's like a 30 to 35% possibility of that in Q3 or Q4. I just can't imagine less than 6 months, 9 months after raising rates, you're going to lower rates, because you got to let it go through the system. Until we get under 4.5% inflation, I couldn't imagine them, lowering rates, even a quarter of a point in Q3 or Q4. I don't see it happening.
Yeah, well, I think I personally think, one, the Fed is obsessed with that 2% rate. But two, as long as employment, we're at full employment or as low as we are as far as the unemployment rate, I don't see any reason that the Fed, knowing who they are, any reason that the Fed is going to lower rates anytime soon. They may pause and stop raising them for a while, but I just don't see them until things get markedly worse. I don't see them reducing interest rates anywhere this year. Maybe into next year if things start to slow down drastically.
I will say this though, many of the Fed members, they're not in the blackout communication period, so many of them are doing their highly paid tours for speaking events and whatever. And what the majority of them are basically saying is what they've been saying for the last 6 to 9 months.
Yeah.
We see a tightening period, a raising of rates and keeping rates at the levels they are into 2024. Now, there's been a few dissenting opinions from that, but the majority of them are already talking into 2024. As a matter of fact, a memo came out that the Fed staff, the ones that are really doing a lot of the analytical number crunching and data science, they basically said they're looking for a mild recession and for it to last 2 years. I don't know about you. I don't think a 2-year recession is a mild recession if that's what they're looking at. So it should be interesting to see actually what really truly pans out here.
Once again, this comes to you from the crowd that said inflation was going to be transitory too. So
of course,
I don't know how much I believe out of that crew anymore. Well,
behind the curve again.
I wish you a good trip, and we'll see you back here in a couple weeks. Folks, we'll still have some shows. I'm actually going to be interviewing a gentleman here this week on talking a little bit about investing in mortgage notes. I think it's an interesting thing. So that's an upcoming show that we have. Ron will be back in a couple weeks, and we will keep this thing going. So thank y'all for joining us today. Certainly love to hear comments, would love to hear ideas you have, interests that you have. So wherever you're watching or listening to this, make sure that you are commenting. If you have questions, we'll answer out of the comments there or address it on an upcoming show. So thanks a lot. We look forward to seeing you here very soon, and have a wonderful week.
All right, guys.